When silver hit $79, everyone felt FOMO. You wanted to buy. You felt like you missed the boat. Now imagine silver drops to 60 tomorrow. How will you feel? Most retail investors will feel fear. They will say, the squeeze is over. It was a bubble. They will sell. But the smart money? They will pop the champagne. A crash in a bull market is not a disaster. It is a gift. It is the market backing up the truck to let you load up one last time before the real move begins. We are looking at a classic flag pattern. The price shoots up, consolidates, shakes out the weak hands, and then doubles. If you miss the move to $79, the coming retrace is your second chance. But you have to have a plan, or you will panic. Let's build the re-entry playbook. To buy the dip, you have to understand the anatomy of a commodity supercycle. Commodities are volatile. They are violent. In the 1970s gold bull market, gold dropped 40% in the middle of the run. It went from $200 to $100 before going to $800. If you sold at $100, you missed an 8x return. In a true silver squeeze, a 20 to 30% correction is normal. It washes out the leverage. It forces the late longs to sell. It resets sentiment. If silver peaked at $79, a 30% drop takes us to roughly 55 or 60. That is not a crash. That is a technical retest of the breakout level. The smart money doesn't buy the breakout. They buy the retest. They wait for the price to come back to the scene of the crime to confirm it is solid. Why are we confident it stops at $60? Why won't it go back to 20 years? Because of the solar floor, episode 12. Industrial demand provides a safety net that didn't exist in 1980. Chinese solar factories need silver to survive. At $79, they might pause buying and use their inventory. But at $60, they replenish their stocks. They are the whale bid underneath the market. Speculators sell because of fear. Factories buy because of physics. You want to be buying when the factories are buying. We can see this in the Shanghai inventory data. When price drops, inventory drains. The physical market sets the floor. The paper market sets the ceiling. So what do you buy? If you want to catch up fast, look at the Junior Miners, episode 13. When silver drops 10%, miners often drop 20% or 30%. They have beta. They are more volatile. This sounds bad, but it is perfect for a re-entry. If you missed the first run in BlackRock Silver or Dolly Varden, a retrace is the time to strike. You are buying the same asset with the same gold in the ground for a 30% discount. The smart money uses a strategy called pyramiding. They buy a small position. If it drops, they buy more. They use the volatility to lower their average cost, because when silver turns back up, the miners will slingshot past the metal again. If miners feel too risky, look at the royalty companies. Wheaton Precious Metals, WPM, or Triple Flag, TFPM. These companies don't mine. They give cash to miners in exchange for a percent of the silver forever. They have no cost inflation. If diesel goes up, they don't care. If labor goes up, they don't care. They have fixed costs and infinite upside. During a dip, royalty stocks often hold up better than miners because they pay dividends. It is the sleep well at night way to play the squeeze. You get the upside of $100 silver without the risk of a mine flooding. For the physical stacker, a dip is an opportunity to upgrade your metal. When prices are high and panic is high, premiums explode. You pay $10 over spot for an American Eagle. When prices drop and the market gets boring, premiums collapse. This is when you swap your generic Buffalo rounds for sovereign coins. Buy Canadian Maples, British Britannias, or American Eagles. Why? Because they are government-backed legal tender. They are harder to counterfeit. Maples have laser security marks. And when you go to sell, dealers will always pay you more for a sovereign coin than a generic bar. Use the dip to upgrade the quality of your stack, not just the quantity. The biggest mistake retail investors make during a dip is watching the screen. You see the price drop, you get scared, you hesitate, you think maybe it will go lower, and then it bounces and you miss it. The smart money doesn't watch the screen. They use limit orders. They calculate the support level, say $58.50. They put in a good till canceled GC buy order at $58.50, and then they go play golf. If the price crashes to $58.50 while they are sleeping, the computer buys for them. They remove emotion from the equation. You must be a sniper, not a spectator. Set your traps and wait. Let's summarize the investigation. A retrace to $60 is not the end, it is the pause that refreshes. The Smart Money Playbook. 1. Don't panic. Expect volatility. A 30% drop is the price of admission for a 100% gain. 2. Buy the lag. Focus on junior miners, ESL, or developer stocks that haven't moved yet. 3. Upgrade physical. Use the lower premiums to buy sovereign coins. 4. Automate. Set limit orders at key support levels so you buy the fear without feeling it. The bus has stopped. The doors are open. This is your last chance to board before express service to $100 resumes. This is the Smart Money Wisdoms. The future belongs to the owners.